each one to do is to introduce themselves and also say what they're involved with currently, because I think that's a very important idea. Needless to say, another two topics of discussion. One, we have to talk about the opportunity zones, or should we say everybody believes it's the best thing around. Mixed emotions on that. And also we have to talk about the life sciences, which is very important because I sincerely believe that a significant amount of the space in Long Island City is going to be absorbed by life science and biotech, especially with what happened with Cornell Tech. But each one of the individuals, we have plenty of questions and plenty of discussions. Bryan, who sold property in the Bronx?
I did.
Okay, so here's an individual who had property for a number of years, and then all of a sudden this year, in November, decided to sell the property. So tell us about what you're doing and why did you sell your post office property in the Bronx?
Sure. Good morning, everybody. My name is Bryan Woo. I'm an EVP at Youngwoo Associates. We're a development firm here in the city. We've been around for about 40 years. We've done about 55 projects. Basically every single asset class. We've done mixed use, we've done multifamily, we've done condos, industrial in the form of data centers, and these days we're very focused on mixed use in opportunity zones. I will say, let's talk about the post office in particular, and I'll just kind of jump into it. I mean, the reason that we sold the post office in part is we could not get any of the benefits of the QOZ. We had already substantially improved the project to the point where the ability to be able to get any of the tax benefits were not there. We got attractive pricing. Our partners and I decided that we wanted to sell it, so we decided to do that. But I can talk a little bit more about how we're looking at sort of QOZ projects in general later on.
Jim?
This one. Good morning, everyone. My name is Jim Simmons. I've spent the balance of my career on various private equity platforms, specializing in multifamily retail, top 20 cities around the country, focusing on re-emerging neighborhoods, many of which were discussed today. But really what I want to do is be as wise as Michael, as accomplished as Frank, and as good looking as Bryan in my next life. We spend a lot of time trying to find value and trying to be smarter than others and trying to find ways where we can make dollars out of nothing in an off-market fashion. So we are not the group that's going to outbid every Tom, Dick, and Harry, but we are the group that thinks that we can find a better solution to the mousetrap.
And needless to say, our money man. Frank.
Good morning, everyone. I actually thought that I was being asked to speak here because of my knowledge of the market and my riveting speaking skills. Then when I heard Bonnie talk about the contribution that we made to the charitable cause, I realized we actually bought my seat up here. So I hope your expectations aren't that high. For us at Arbor, I think most of you in the audience know who we are. We are a company that dabbles in a lot of different areas in the commercial real estate space, but our primary focus is on lending and specifically lending in the agency space. So in that particular business, things have been really terrific. We've been on a 10-year run or something like that. And the truth of the matter is, notwithstanding some of the risks that are out there, at least from our perspective, I think we see blue skies. I know it almost seems impossible that you can continue to look out and see, no storm clouds on the horizon. But the truth of the matter is, we need rental housing in America. We need affordable rental housing in America, both capital A and lowercase a. That's the area that Fannie and Freddie specialize on. That's the area where we play. And I'll tell you, we've got 5 or 6 guys in the audience today. We did $5 billion in agency debt, another $2 billion on our balance sheet. We've got 20 or 25 guys. The per capita production level out of our gang is really high. They're very strong. We cover the entire country. And I don't see any real slowdown. Maybe a little. I think combined agencies did maybe 140 billion. Maybe it'll be 130 billion next year. Maybe it'll be 150 billion. By any measure, that's still an incredible amount of multifamily debt that they're putting on the street.
One comment that Shimon put at the end, he brought up the subject of co-living, which is a perfect lead-in for a variety of the speakers over here. When you take a co-living situation and you have an apartment that may have been rented for, let's say, $3,500, it had 2 bedrooms or 3 bedrooms. So now you go to a co-living concept, each bedroom is being leased for $1,500, so your rent is $4,500 a month as opposed to $3,600 a month. How do the agencies look at this when they're underwriting a loan? Are they underwriting the loan at the $3,600, which is the actual market rate, or the co-living rent, which is different?
Yeah, I think to the emergence of the co-living concept is still being digested by the agency. So I think today, probably, look, we can make the argument if there's operating history and whatnot to support the co-living rent, and you see that in student housing properties, right? That's sort of where it originated.
Right, but that's a specific asset class that people understand. Now we're going to a situation where you're taking a room which may be 80 square feet. There are common living facilities over there, and we're in a different market. I know that a number of the balance sheet lenders who may be sitting over here are lending based on the actual market rent as a stabilized unit as opposed to co-living. So the bigger question is, how do the agencies, because this is a different approach and it's not student housing.
No, I agree. And so the point that I was going to make is I think you got to go to the credit side of the house, right? And they're going to say, if we end up taking this deal back, can we support the rental program that's in place today? And the inclination at the moment in the marketplace will be to lean towards underwriting to market rents.
Okay.
So I actually have one thought on there. So, we studied co-living pretty extensively, and I've been thinking about it a lot. So, look at the proxy, right? So if you look at co-working versus co-living, I think that the big problem with co-living is it doesn't solve as big of a problem as co-working does, right? So all co-living does is increase densification in the asset, but it doesn't, so what does co-working do? Co-working solves the idea that you want fundamental flexibility in growing companies or companies that are trying to create satellite offices or shrinking companies, right? And so they exploited sort of this old way of doing business in office leases and were able to create something that was of extreme value, flexibility and the ability to upsize and downsize pretty rapidly. Co-living doesn't really do that. I mean, what are the things that co-living does? It allows you to, the best thing that I can think is that it slightly densifies the apartment unit, and then it allows you to get rid of security deposit. Like, that's the only barrier of entry that it eliminates. And I don't know, I don't think it's as revolutionary as co-working is. There's definitely a use for it, but I just don't see it being on the same scale as co-working.
Jim, I have a twofold question. I want your opinion on co-living, and I also want your opinion with regard to the sale of affordable housing, the Starrett City deal, because you, a couple of years ago, with A&E Properties, bought Rivington and kept it affordable for a 30-year period.
Yeah, so let me just address the first in my thoughts, because I'm not in space, but in New York City, we've been having co-living happening for a long time. So if you look at the Upper West and the Upper East Side, if you're a recent graduate from college, what typically happened is you went into a 1 or 2 bedroom apartment with 3 or 4 of your friends, you built a wall, and you shared a bathroom. And that actually,
as I say, traditionally, co-living started at the beginning of the 20th century when the refugees came over from Ellis Island and they shared rooms in the Lower East Side and around the city.
right, so it exists today in a separate form, and it exists for a long period of time. And that's partially what gave us the impetus to start investing in Harlem, which was if we could create a product that equated to the Upper West or Upper East Side, and you can trade for the same rent, a 1-bedroom closet that you're sharing a bathroom with 3 other people, with a fully renovated 1-bedroom apartment in Harlem, where, by the way, your commute to your job on the West Side is quicker than living in the Upper East Side, then we'd have a compelling business model. So I don't know what the future of co-living is, but I tend to agree with Bryan. I don't think a larger opportunity, or as large an opportunity, as co-working. On the affordable side, I think that what you're going to find, and what we've seen, there are a couple of facts, right? Our city has gotten a couple of things right that have happened, but we really don't notice it. So the first of which is we live in a mixed income, and in many cases, very disparate mixed income environment in relative harmony. So if you look at the placement of public housing, within 10 blocks of most public housing, and we'll use Manhattan as an example, you have very high income housing in close proximity, in some places right across the street, right next to Nova. And that has permeated sort of the thought process that mixed income buildings work well. And thirdly, that we do have to protect the individuals who actually work for a living, as opposed to all of us in the room who sit behind desks most of the day. So the fire people, the police, the teachers. We cannot have a city that thrives and exists without those individuals. And based on a pure market and capitalist society, it really doesn't work when everyone wants to live in Manhattan, or everyone wants to live in close proximity to their jobs. So there has to be some protections put in place. My thoughts about rent state and rent control aside, whatever the construct is, it's best if it's one that is negotiated between us as the owner and the regulatory authorities. And so what happened at Starrett, what happened at Riverton, and what I think is going to happen with many of these large deals at Stuytown and the like, is that ownership sat down with the city or the state and said, how can we come up with a solution that works for you and works for us, and provide long-term affordability, but where we can still live with under a capitalist construct. So for those groups who can do that, I think there's more of that to come, and hopefully we're one of them.
Okay, would you want to explain what you did in Rivington? Because I think it's an interesting example, and I think it was followed at Starrett with regard to keeping the affordability option and the three different levels over there in rents.
Look, it's a pretty basic construct, and the mold was Stuytown. So it was essentially, with the city, you sign a long-term regulatory agreement that says that you're going to restrict rents over some very long period of time, 20, 30, 40 years, and in exchange for that, you're going to get some tax benefits. And so that's the very simple construct. So over the next 30 or 40 years, the nature of that asset is not going to change very much from a socioeconomic perspective. And that's what you want. You want people who've lived in these neighborhoods to be able to stay there. And I think that's a more effective way to do it than some others that are currently in existence.
So here's a question, with regard to lending and with regard to another comment that Shimon made. When the new legislation is taking effect with market rate, with market stabilization, with vacancy decontrol, with MCIs over there, what effect is this going to have with regard to lending? One. Two, in a similar manner, one of the biggest problems is that a number of people over the last couple of years were able to get 3.25% financing on a 5-year loan with a adjustment on term. Now T-bills are not as high as they were before. A 5-year loan on a multifamily, the best rate is probably 4, as opposed to 3. Proceeds are going to be less. How do you see the agencies in your business handling that?
Well, look, I think that the play is, and the hope is that, and first of all, let me back up for a second. When you look at cities where there is tremendous growth and tremendous economic prosperity, that's where you have the most amount of pressure on affordable housing, and it's where you see the greatest government effort to try to do something about it. It's sort of a good problem. not a bad problem to have. New York is doing, tremendously. LA is doing tremendously. San Francisco is doing tremendously. And these are the cities where people cannot afford to rent houses. And so they're getting pushed further and further out. I don't know what the solution is. I don't think that you can solve it completely with legislation and regulation. It's about the best that we can do. But it is what it is the way that I see things. Those same cities, from a lending perspective, are solid gold, and the deals come in, and we can't.
And my question is really with regard to the amount of the loan. Okay, the loans were underwritten at a loan to value when you were using a 3% rate. Now the rate has to be 4.25 over there. How are the individuals going to be able to refinance that? One, will they be able to get higher levels of financing from other alternative sources? I mean, how do you see that?
Yeah, I think that most of the debt that's out there over the last 4 or 5 years, rent growth has slowed a little bit recently, but there has been rent growth and there has been value appreciation. So from my perspective, everything that we see that we're refinancing that we did 5, 6, 7 years ago, all the cash flow that we're underwriting supports debt at the current rates today. So we're able to take out. We have not run up, really in any circumstances, situations where we've been unable to refinance existing debt.
Okay, since everybody has been talking about this opportunity zone, Bryan, you've been pretty active, or you're planning to be active. Why don't you tell us what you're doing and your different approach as opposed to certain individual approaches, with the REIT approach, the crowdfunding approach, and so on.
Sure. So, when we first heard about this thing about a year ago, I'm going to back it up and kind of tell a story about how we ended up getting into the opportunities in space, which was we were already developing about $300 million worth of product in opportunity zones, unbeknownst to us. We were developing a post office over on 149th and Grand Concourse, and we were developing a mixed-use commercial hospitality building on 181st Street in Amsterdam. Somebody came to us and basically said, you should look into this opportunity zone concept. I had no idea what they were talking about. And this was almost a year ago at this point. Obviously, I've gotten up to speed, and obviously I think it's a brilliant program, and we plan to utilize it to its utmost benefit. I will say, obviously there's a lot of ambiguity out right now about what you can and cannot do, right? Without getting too much into the weeds about this, our thought is stay simplistic until regulations tell you otherwise. What we do know is this. If you go out and you buy one building in a single LLC, you develop that building, meeting all of the substantial improvement requirements, all the asset type requirements that you have, you hold it for 10 years and you only invest cap gains, you will get the benefits of the program. So we know that. However, real estate is always a little bit more complex than you would like, right? So as you kind of get into the weeds of every single deal, a lot of questions arise, and people right now, I think, are simply making leaps of faith, understanding that the regulation will eventually catch up to them. I think that's the smart thing to do. I think it's what we're planning on doing. We've been spending the past couple of months really negotiating, I would say, some fairly high-profile deals that we hopefully can announce pretty soon. And they're going to follow the standard protocol that I just talked about. We're going to invest in a single building, we're going to improve it, we're going to deliver it, we're going to stabilize it, we're going to hold on to it for 10 years, and then hopefully get all the benefits of the QOZs.
And where are you going to get your investors from?
That's a good question. Originally, when we started out the program, the plan was basically to tackle it with sort of concentric circles of relationships, going out from the people that we knew the best to people that we met for the first time, to people that we were introduced to. And then I wanted to sort of supplement it with crowdfunding, because the idea was basically, if you look at the universe of capital that was going to invest in this, you X out sort of the major investors in real estate, right? The pension funds, the insurance companies. You stick to high net worth individuals, and high net worth individuals is a catch-all bucket for people of vastly different wealth profiles, right? So someone who can invest $100,000 to $10,000 to $10 million. I have no access to the person who can invest $10,000, $100,000. Those aren't the typical investors in my deals. So I teamed up with Equity Multiple, basically the concept that we were going to work together to access these different buckets of capital. I will say it was all predicated upon the idea that we would be getting regulations shortly that very distinctly clarified how all this stuff would work together. I think that the smaller investors are a little bit spooked when they hear about the ambiguity part, and so I'm leaving open the option to continue to work with smaller investors.
I think it's a double question. Very few people like holding something for 10 years which are illiquid.
Yeah.
And I think in the similar manner as the ticks going back a number of years ago, people aren't aware of it.
Yeah.
And for people of my baby boomer age category, I remember the tax shelter syndications. And I believe that there are individuals who are planning to get involved as opportunity zone people and principals who may not have the most scrupulous approach of what they're going to do. Now, I do believe that if a major brokerage firm like Goldman or Bernstein Investment Alliance or anybody like that get involved with it, it'll be in the same way that they went out to their clients and said, here's another option for you, but be aware that it's a 10-year hold.
Sure.
Be aware that you may not have cash flow. Be aware that we're going to take a significant amount of fees over the period of time.
Sure. I mean, keep in mind, this is one of the hurdles that you have with opportunity zones, right? You have two deals packed in one. You have a development deal and then a stabilized asset going forward, and it's a liquid for the entire duration of the investment. It's a little bit, I mean, unless you really understand real estate and you understand, I mean, if you trust the developer too, it's a hard thing to get your head around. I mean, the reason that we in particular are so into this concept is, if you look at the Venn diagram of who I think is going to be successful in this space, you have to have historical operating track record, right? Because you have to exist in 10 years. That's one. You have to understand how to basically develop buildings. That's not a huge barrier to entry, but there are a lot of real estate investors out there who are primarily focused on stabilized assets. And then the third thing is you have to understand the zones in and of themselves, right? So I heard the stat 541 zones in New York. I guarantee you every single one is completely different from the other, right? And a lot of them are in areas that are up and coming. You have to understand that area. You have to have experience playing in those areas. And I think we fit the bill for that.
Yeah, Bryan and I have discussed this. I think that, and I have a history of being the former CEO of the Upper Manhattan Empowerment Zone. And the Empowerment Zone legislation was one of the frameworks that the Opportunity Zone legislation was drafted on. And I think that everyone has to be thoughtful and mindful, because the unfortunate outcome may be that 6-7 years from now, we look back and we say that there were some very definitive and obvious mistakes made that if you just look backward a little bit were obvious. So one of the facts that I definitely hang my hat on is I don't believe that the next 7 years are going to mirror the last 7. Right? There will be a recession at some point in time during that period of time. If you look back to the last recession, a lot of bad things happened. You had deals that got on the ground, never got built. You had deals that got built, but got taken back by a lender. You had all sorts of bad things that happened. So under the umbrella of Opportunity Zone, if we hit a recession, or when we do, and those bad things happen, is it just going to be that it was a bad real estate cycle, or is it going to be that the Opportunity Zone legislation was bad? Now, what Bryan said is very true. And that's what they have, and I don't have any fear for groups like his that have an operational track record, and that people can feel comfortable that if a deal goes sideways, that they're not just going to walk away, or they have the depth of knowledge as well as the balance sheet to get a deal done. But there are a lot of players who have now shown up to the table that don't have the capabilities that they have. And they will be able to raise money, and they will get deals in the ground. They may get deals built, and then we'll hit a recession, and you'll see a lot of foreclosures and the same stuff that we saw last time. So the tertiary and fourth level issues are the ones that concern me, that this impending recession will bring to the fore, and the old adage of when Manhattan gets a cold, the Bronx gets pneumonia. That's true. So when things go bad here, things go really bad in places like that.
So
Yes.
Well, I was just going to say, one of the things that Jim said that really sort of echoed in my mind was, I think we have really short institutional memory. I think everybody forgets 2008, 2007. That you didn't have financing that was available. It just wasn't there at any level, at any rate. 20% at 50 LTV just wasn't there. So keep in mind if that happens again, that's going to be an issue. And I think you want to be partnered with somebody who's going to be able to kind of make it, who has proven to be able to make it through that kind of situation with development deals.
And the only other point I'd add to that is I think that the opportunities that Bryan talked about, the concerns that Jim has, and the concerns that Mike have, I think they're all right on the money. But the other thing that comes into play here is we're talking about the need for affordable housing, right? And you look at these opportunity zones, they're going to come in, people are going to make big investments, and what's it going to do to the population that's in place, right? These are oftentimes blighted areas. These people are going to be displaced and pushed out. It seems to happen over and over. So the intention is good, the economic investment comes in, a neighborhood gets revitalized, but too often I think the residents that are there, the residents that are supposed to benefit from this are pushed out. And it just repeats over and over.
You're talking about neighborhoods, and part of Shimon's presentation said that the Bronx sales were down. With the exception of the Brookfield sale, which was significant, sales were down. Now, you sold in the Bronx also for a timing effort. You went into Washington Heights, and you went into a mixed-use project called the Radio, correct? How is your view of the hospitality market?
Sure. So for us, what is real estate? It's three tenements, right? It's location, location, location. We love that location. We love that area. I mean, if you look at Upper Manhattan, you have a population of 250,000 people. So roughly the equivalent size of, I think, Buffalo, New York, or Pittsburgh. And I think you have a total of 104 keys in that area. Now, I know it's not the exact same sort of comparison, but Buffalo has 3,000 keys. So we kind of looked at it and we said, all right, this is a fundamentally underserved market. We believe that if we bring in something here that's affordable, that's domestic, and what I mean by that is that it caters to the people in the neighborhood rather than relying on other people moving in, we think we're going to be successful. And that's been the thesis that we've sort of carried through all of our developments, right? When I talked about that sort of Venn diagram and understanding neighborhoods, I have found in general that when you go into new markets and your concept is that you want to go in here and basically kick people out rather than bring people in, you always make it more difficult. It's always more difficult to permit something. It's always more difficult to get something approved. It's always more difficult to lease it out. It's always more difficult to be successful. So for us, I think that the radio tower and what we're trying to do over there is a continuation of the same thesis that we've had for 40 years.
Jim, what's your thoughts about the hospitality market in New York in general, in the region? Because I don't think you've really done hospitality in your career too much.
I don't like it. I just don't. Whenever there's a downturn, it's the first thing that goes to zero immediately. In the buildings that I own, there's friction and switching costs. If you're going to pack your apartment and move, I pretty much know about it, in advance. In the hospitality sector, you just decide not to show up, and the macro, its dependence on macroeconomic health is large. I mean, if people stop traveling, you have exogenous issues like what happened in 9/11 where people just stop. So I just don't like businesses that are that unpredictable, just as a general statement.
Frank, as a lender, how do you and Arbor look at the hospitality business?
Yeah, I got to be honest. We don't plan it that extensively. I think we see opportunities here and there along the way, but it really gets back to some of the things I was talking about. It's all about we wouldn't completely shy away from it, but it's not something that we actively pursue.
Another topic of discussion in Shimon's presentation was retail. Now, if you follow the approach, I think there's a great example of the change from the clicks and bricks to brick and mortar. And the File organization did that on Madison Avenue and 49th 50th Street, where Bonobus went over there, then Untucked, now Jack Irwin, and a variety of other stores, as well as with Warby Parker. How do you see the changes of stores in the same way that Shimon brought up the Amazon Go, Amazon 4-Star, the Whole Foods and the supermarket? How do you see different aspects in different areas of retail in general?
Well, let's talk about it this way. Retail is not dead, right? I mean, that's not the way to think about it. There is a rent rate at which you can rent out every single store in Manhattan. That's not the issue. The issue is that some people overpaid for them, and they have to get a rent rate that makes the prices that they're asking for are just too rich.
With regard, Jim, you've been involved, as you said, with the Upper Manhattan Empowerment Zone, and you've really seen the resurrection or the change of stores from the mom and pop stores on 125th Street and Harlem to the national chains. How do you like the retail in general? And I think I'm very bullish on retail, especially the outer boroughs, and I think certain parts. What's your thoughts about retail?
Yeah, look, going back to what Bryan said earlier, if you look at Upper Manhattan and the way that we looked at it from a retail perspective, in a similar way they looked at it from a hospitality perspective. And by the way, I think his job would do very well because the demand stats are off the chart. Because 104 rooms for a city the size of Buffalo, that just makes sense. But we looked at it from the same perspective, retail. And I'll get to your empowerment zone question, but you take a city of that size, and prior to the Pathmark opening on 125th Street back in the early 2000s, which doesn't exist today, but when it opened, it was the #1 performer in the entire system. Now, you would, if you thought about it, you'd say a city of that size, one full-service grocer. You might ask yourself why that is, but you would probably say they would do very well. Same is true of Whole Foods. So a lot of people said Whole Foods was going to do well on 125th Street. And I believe it's #4 in the Northeast right now, 3 or 4. And you got to take out Time Warner Center because it does the far strips anything. So for all intents and purposes, #3 for like stores. So it's location, it's demand, and it's what the product is. So there are a lot of things that are doing well as retailers shift to a more urban platform, basically because these neighborhoods were bereft of these services for many, many years. When people depopulated in the 60s and 70s and early 80s, now they're repopulating, so retail is following.
I mean, if with regard to that, just in general, the off-price retailers, the TJ Maxx, the Burlingtons, are doing excellent over there. The Five Below, which opened up on Fifth Avenue, opened up 120 stores last year, the dollar stores. So I think, people don't realize that there are certain retailers doing fantastic throughout the city and throughout the marketplace.
Correct. Now let's get to your second question, which is my experience at the empowerment zone and the small mom and pops. What we try to advise businesses to do, which was the exact opposite of the way they historically ran their businesses, was to sign as long a term lease as you can with your building owner. And typically speaking, they shy away from it. I don't know if it was just the way that they were taught, but they were doing 5-year leases, 10 years max. And our advice was, look, the neighborhood is changing, 125th Street is definitely changing, rents are increasing. When you go to re-up, you're going to be paying a lot more. So you saw a displacement of some of those mom and pops from 125th Street proper, and many of them relocated to the avenues, so a block or two off. Now, hopefully their sales maintain, but part of having national names come in is they can pay more, and so therefore you have increasing rents, and the mom and pops do suffer, but you do have new mom and pops. So you have, mom and pops who are doing different types of things and offering different types of services, and I think it's up to the businesses to adapt, unfortunately.
Frank, what's Arbor's view on retail?
I got to be honest with you. When I got into the lending business 25 years ago, it was in the apartment space, and apartment wasn't that sexy back then, and retail was very sexy. I appreciate all the optimism that you guys have around the various opportunities in the retail space. From my perspective, I guess I look at it and go, well, if these guys are going to do well in that space, they better hope people keep eating out. That's I don't have a lot to say on it, to be honest.
Okay, so here's a question specifically to you. Why don't you explain the small balance program and some of the programs that you do with the agencies and on your balance sheet?
Sure. We so we play with both Fannie and Freddie have numerous products that they put out on the street. We play in everything that they do. We do student housing, we do affordable debt, we do conventional debt, and we do small loans. The truth of the matter is the underwriting of a small loan, the agencies both have housing goals that they have to hit that are tied to the delivery of small deals, typically like 50 units or less or $6 million or less. And they are slightly more aggressive. They make the underwriting process a little easier, and we deliver. Like I said, I think we were second with both Fannie and Freddie in the small loan space. There is tremendous competition for small deals here in New York City from the banks. We win some, we lose some here in the city, but we do it nationwide. It's a little easier to put the money on the street in some of the secondary markets, but it's good debt, and we do a lot of it.
So here's a question, and this one may be because of my age and other categories. One area that recently, which was not brought up in Shimon's presentation, is the amount of newly built senior housing. Right now we have at least three projects under development in the luxury senior housing market. One on 93rd Street and 2nd Avenue, one on 56th Street and Lexington Avenue. Another site was recently acquired on 3rd Avenue and 34th Street, and I believe there's another senior housing being built on the Upper West Side. What's your thoughts, as developers, as people in the real estate, and also because it's a housing situation, on how the agencies might look at financing luxury senior housing?
So, unfortunately, I don't know the space that well. I know I have friends who are in the space. I've talked to them about the space, but I'm going to preface my statement by saying don't trust what I say because I'm not an expert. I'm just going to opine for no reason. It's obviously a great business model, right? Like, if you look at the demographics, we as a society are getting older, and we need to house the people who are getting older. And it just makes sense that generation that has been so good at saving capital wants to improve their quality of life as they get older and wants to go into luxury senior housing. It makes all the sense in the world. I've seen a lot of proposals to convert, old, tired hotels into luxury senior housing facilities. I think that's a great idea. That's a great rehabilitation of the existing building. But other than saying that, I think it's a good business model. Unfortunately, I don't have a lot to say.
I'll ask Jim to opine on the subject. Someone told me that the apartment on 93rd Street and 2nd Avenue, a studio apartment, is renting for $16,000 a month. The rental office is open. Now, needless to say, people who may have made a significant amount of money in the sale of their home, or they don't want to move to Florida, but $16,000 for a studio apartment is a rather expensive situation. Jim?
Yeah, look, for those of us who are a little bit longer in the tooth and are dealing with these issues with our parents, loved ones, there are a couple of facts about senior housing, and we're in the process of looking at a couple of developments and so. Number one, once you get them in, they generally don't leave. Number two, your delinquency is generally zero. If you can get it built, then there's generally a large demand. And here's why. Part of the reason why. Let's talk about New York, Manhattan. I'm part of the generation that grew up in the suburbs. So Jersey, Westchester, Long Island. And that my dad commuted into the city, an hour, 15 minutes a day. A lot of us in the room live in Manhattan or live in New York City for a number of reasons. And a lot of us have kids. And a lot of grandparents really love their grandchildren more than they love their children. So they want to be close. And they want high quality health care, which we have. My dad just had surgery, he lives in Jersey. He had it in Mount Sinai, not in his local hospital. They want to be able to go to plays and do a whole bunch of stuff and have active lives and not have to necessarily drive. And with Uber, it's really easy for them. So all of these factors make what retirement used to be, which is you stayed in the suburbs and you had a house that was much too large and your kids and grandkids came to visit you and hang out. That really doesn't happen that much anymore. My parents spent more time at my house seeing my kids than at their house. So all those factors mean that people are changing the way that they spend their quote-unquote golden years. And living in a place like Manhattan, where crime is now low, you don't have to worry about getting mugged, you can take public transportation around. Our cultural institutions are fantastic. All of those drivers mean that senior housing is a great place to invest up and down the spectrum, from the very high income, $16,000 a month, to the very low affordable.
As how do the agencies look at that type of financing?
Yeah, well, look, generally speaking, in the senior space, the agencies exist to provide liquidity for housing, right? And providing liquidity for housing for seniors fits squarely in their sights. When the agencies got into the seniors housing lending business, they were looking for top operators and high quality properties. As time has evolved and their knowledge has grown about the product and the performance of the portfolio has proven to be very good, they have expanded their box. I don't know that they've necessarily expanded it upward into the ultra luxury type stuff, but they're doing more middle market type senior housing in addition to high quality stuff. I will say this, when you look at, you can probably generalize what you see in the apartment, the conventional space to the senior space, in that in terms of diversifying risk across their lending portfolio, you're going to do a lot of workforce housing type stuff. But it's good to spread a little bit of the risk into some of the higher end luxury stuff. So do I know and do I think that there is room for them to move up in terms of the quality spectrum of senior housing? The answer is absolutely yes. What level of high quality, I really couldn't say.
I'd like to leave the open to questions right now. Are there any questions? No questions from anyone? Yes, young lady.
I have a question about kind of the big box stores on Fifth Avenue, like the flagship retail stores. As landlords are kind of stuck with them and may not be able to fill them, how likely do you see an increase in the coming year or so of like subdividing and purchasing that space? Just larger
Right. The question was, there are a number of big box stores or large retail places that have closed. Do we see some of these big box stores being redistributed, resized for other tenants? Am I correct? I think I think a great example is 530 Fifth Avenue, which was originally planned to be a Simmons, then a Filene's warehouse. Today you have, as I said before, you have a Five Below, you have a shoe store on the corner, you have a bank, you have a variety of things. So I'd say that people are reducing the size. And I think as Shimon brought out before in the Target example, the Target store on 34th Street is like 24,000 square feet. And if you go down to the Lower East Side on Delancey Street and you'll see a Marshall's, you'll be shocked that there's a Marshall store over there. So I think the city is adapting and different retailers are looking at different approaches. In the same way that the original Time Warner store of the Whole Foods was huge, was probably 60,000 square feet, and the Whole Foods in Harlem is, about 30,000 square feet? Right.
I think what you'll see, as an example of what's occurring, the Lord Taylor deal that happened when we were. When the equation of the value of the retail, of the value of the real estate as another use far exceeds the value of the real estate as a retail, you'll see a shift away. I don't know if we'll see the Bloomingdale's or the Bergdorf's or the Macy's, those flagship buildings that are really tourist driven in terms of their revenues. I don't think we'll see them go away, but I think that some of the other large boxes that don't really have that draw, you're going to see shifts to other uses.
Any other questions? Yes.
Assuming that the proposed changes to the rent regulation law is passed as proposed right now in June, How do you see that impacting pricing of rent stabilized multifamily assets, say in boroughs or even in
Yeah, I recently did a couple of shows on that topic specifically, and the owners who were on the show made a blunt comment. I don't want to buy anything that's rent stabilized. I want to do market rate. So that is part of it, and I believe, I don't have Shimon's statistics, but I would say that sales are down in certain markets for the rent stabilized would be unprepared. We're unaware of what's going to happen. The MCIs and all the rest, if there are controls that could have detrimental effects to be an owner of property.
And one thing that will be positive is, like you said, the free market units or apartment buildings with mostly free market units are going to benefit. Rental apartment buildings that were built recently with 421A tax abatements are going to benefit. In a way, project-based Section 8 buildings that have a up to market feature which changes every 5 years, positively, hopefully changes every 5 years, which act like free market will benefit. And the last category is buildings that have 10 units and under, which have a tax advantage because you're capped on how much you can increase taxes there, will benefit as a result. So,
Yes.
Just related to this, I heard there's a package of about 50 bills on the table at the City Council, many of which are introducing new types of rent controls and even rent control for office space. Can you comment on the direction the city's going in if these bills are passed and passed?
One thing I always do, don't talk about politics.
I'm okay. I'm going to take that one.
look, we don't know what is going to happen if they pass. We hope most of them don't. It's as simple as that. I mean, we have right now, the bills that you mentioned. We'll have to wait till July to see what happens and what doesn't happen. And that's part of the uncertainty that's revolving around with regards to underwriting rent stabilized turnover. But again, you also can see the opportunity in what's going to happen, how investors are going to look at apartment buildings in general. That's what I tried to mention before.
Thank you, everyone. Great discussion.
Thank you, everyone, for being here. Thank you, Michael.